exploring the amazing story of the Welcome Stranger, the largest alluvial gold nugget ever discovered. It all began on a sunny day on the 5th of February 1869 in a remote place called Bulldog Gully, located in Victoria, Australia. This was the day that would go down in history, thanks to two determined Cornish miners, John Deason and Richard Oates. Little did they know what they were about to stumble upon. Picture this. John and Richard, hard at work like any other day, were digging in search of gold. They had no idea that they were about to make one of the most significant discoveries in the history of gold mining. As they dug deeper into the earth, the shovels hit something hard, something that didn't quite feel like the typical rocks and dirt they were used to. With bated breath and growing excitement, the two miners carefully unearthed their find, and to their astonishment, they had uncovered the Welcome Stranger, a colossal gold nugget weighing approximately 72 kilograms. Just try to imagine the rush of emotions they must have felt in that moment. The Welcome Stranger wasn't just remarkable for its size, it was also incredibly valuable. In those days, it was worth just under £10,000. To put that into perspective in today's currency, and based on the size of the gold nugget, it would fetch over $10 million. Can you imagine holding that much wealth in your hands? But here's where the story takes a twist. There were no scales capable of accurately weighing this colossal gold nugget at the time. So what did they do? They made a bold decision. The Welcome Stranger was carefully broken into pieces on an anvil. After being transformed into manageable chunks of gold, the Welcome Stranger's gold pieces were weighed. They were sold, and eventually they were smelted down. The gold's final destination was the London Chartered Bank in Denali, where it began its journey into the world of commerce. Now here's the incredible part. Despite the immense excitement surrounding its discovery, no photographs or casts were taken before the Welcome Stranger was broken up. Instead, sketches were created from memory, and replicas of the Welcome Stranger are based on these sketches. It's a testament to how the world was captivated by this discovery. So there you have it, the remarkable story of the Welcome Stranger, found in Bulldog Valley, Victoria, Australia, by two adventurous Cornish miners, John Deason and Richard Oates, found on February the 5th, 1869. Its weight, its value, and the daring decision to break it into pieces all contribute to this legendary status in the world of gold mining. Welcome to the Australian Gold Conference 2024.
Ladies and gentlemen, what a great voiceover. Hello, my name's Drew DeCavallo. I've flown in all the way from America for this. Kerry's been a friend of mine for over 30 years. I'm sorry about that, Kerry, I didn't tell him. But anyway, it's wonderful to be here. I've been in America for about 30 years doing voiceovers and stuff like this, and when I heard about this conference about 2 years ago, a friend of mine told me I should invest in gold. I had a little bit of money because my mother sold her house, thank goodness, and boy oh boy, it's the best thing I've ever done. And I know nothing about investing. All my friends who came to New York were in the banking business. They made so much money, and I was meeting them after dinner. I'd say, I'll see you after dinner, because they'd be dropping all that money. But the time to be investing and learning about this is now. And I'm going to be the rouseabout and the person sort of joining all the sessions. If you're coming tomorrow, over the next couple of days, we're going to have a lot of fun, but we're going to learn a lot. And learning about this and being smart is what it's all about. I do remember my only connection to gold, and my mum's side of the family, my great-grandfather came to Australia. My great-great-grandfather came to Australia, and his brother went to Rhodesia with Cecil Rhodes. And when he got there, Cecil said to him, listen, for coming over on the first fleet, I'm going to give you all this land. And he said, screw the land, Cecil, give me some money. So he got all the money, and of course he gambled it. But right then was when the gold rush was happening. So the family then decided, well, what can we do in a gold rush? And they say the people who make the best money in the gold rush, especially initially, are not the people who find the gold, it's the people who sell the shovels. And so they started trading shovels and selling wheelbarrows, and they became very, very wealthy. And that was my lesson about gold. But ladies and gentlemen, enough from me. I just wanted to welcome you here today. We're going to have 2 incredible days, an incredible group of people on the stage here to tell you all about what it's all about. And I'd like to welcome now the reason why we're all here, the founder of the Australian Gold Conference, the Australian Gold Conference, Kerry Stevenson.
Thank you very much. Thank you, Drew. Thank you, Drew. Wow, wow, wow. Evening, everybody. How are we? Oh, that's pathetic. Guys, I know it's Monday, and I know the DJ hasn't started yet, DJ Mike Dotch. Who's here for the drinks? Don't all of you come, because I'll go broke. And it's Monday, so just be careful, be quiet, be calm, have one drink and go home. No, I'm just kidding. There's a lot going on this week, And my encouragement to each and every one of you is some of you, who's here for the first time? Wow. That tells me that this market is only just getting started. And I'll tell you why. For many, we've been doing this conference for 14 years. I've always believed in money. Gold is money, everything else is credit. But most of you trust the paper, and I'll go into that in a little bit. But one of the things I want to encourage each and every one of you if you're coming for the next, who's coming for all 3 days? Great. There are going to be a number of you here that are newcomers. There are going to be a number of you here that don't know anybody else. Maybe you're here on your own. I would encourage each and every one of you to make this a safe space for those that might not know anyone. Don't get into your cliques and get into a huddle and ignore those people out there that might not know anyone else. Do you all agree? I'd love you to all go and speak to somebody that you don't know and encourage each other to understand what you're all here for. Does that make sense? You all agree? Makes it a much nicer thing, because that's the problem. We all stand around and we all get in our cliques, and I don't like that. So, if I can have that from you, that would be fantastic. Let me get into a bit more formal stuff. I am really excited to kick off another Australian Gold Conference because it's a very interesting time for gold. And this year we've seen a significant increase in global attention to the gold sector. I'm sure you've seen it. It's coming up in mainstream news at the moment. And also we're all trying to pay attention to what's going on and interpret the changes that we see happening. And we're trying to predict the impact that will have. Now, we're really pleased tonight to welcome guests from near and far. We have the Ambassador of Peru attending the event, along with some other people from Peru. There's a connection between the gold markets, Peru and Australia, and I'd like to thank Alex Scanlon for instigating that, because it is all about conversations going forward. My name, as Drew said, is Kerry Stevenson. I will be your host this evening, but I really want to first up say thank you to Michael Pepper, who's standing quietly in the corner. Michael is the founder of Bullion Now. They are a Melbourne-based bullion dealer, and if it wasn't for Michael sponsoring this event, we'd make you all pay money, and yet we haven't made you pay money. So please thank Michael Pepper. You'll have a chance to speak to Michael and his team after we finish. They've got a booth directly at the back there, but also another one down the side. Have you got some metal with you tonight as well, Michael? Oh, what have you got? Silver?
Silver and gold.
Oh, he's got silver and gold. So if you're excited about buying some silver and gold, you can go and see Michael and be quick. And while I'm on that, there's also a fantastic display at the back there. Gap Marketing, gold nuggets. Oh, that sound's going a bit weird. Is that because I'm standing too close to the lectern? Probably. Look, let me get into this, ladies and gentlemen, because I want you to understand I'm an investor with a curious mind. I'm curious about government spending that seems out of control. I'm curious about why many people don't view gold or silver as investable. I'm curious about why people fear inflation, but then you all trust paper backed by nothing. I'm curious about why governments seem to know something we don't. Suddenly hoarding as much gold as possible while pushing those government-sponsored digital currencies that we all hear about. But ladies and gentlemen, more importantly, I'm passionate about helping people like yourselves ask and understand these questions and consider the opportunities that precious metals are going to afford you in these circumstances. Because gold has captured the imagination of civilizations, from the pharaohs of ancient Egypt to the treasure hunters of the New World. And today, it remains a symbol of wealth, stability, and security in an ever-changing global economy. We are standing at the crossroads of opportunity and uncertainty. We need to understand the unique role that precious metals can play in our portfolios and also our financial strategies. Because it's not just a metal, ladies and gentlemen, it's a legacy. It's withstood the test of time, it's maintained its value through wars, financial crises, and technological revolutions. For more than 5,000 years, paper currencies have arisen, government printing, and crashed in purchasing power, but gold has still remained a reliable store of value, a hedge against inflation, sovereign risk, and a real safe haven during periods of market volatility as we see today. But the enduring power and appeal of gold lies in its intrinsic properties. And what are they? Well, it's scarce, it's durable, it's universally accepted, and unlike other assets that really are subject to what I call the whims of government policy or corporate performance, gold is immune to default risk. It can't be printed. It doesn't rely on the health of any particular economy, and it makes it a truly global asset. And that's what I really want to impinge on you tonight. It is truly a global asset. And in today's investment landscape, it offers several compelling advantages. What are they? Well, first up, it's going to serve as a hedge against inflation, and we all know that inflation is not transitory, it is very sticky. When the purchasing power of your fiat currencies erode, gold tends to appreciate in nominal value. Thus, it will help preserve your wealth. That is particularly relevant in the current environment, where all of us know inflationary pressures are mounting across the globe. It will always provide diversification in a well-balanced portfolio. And by the way, ladies and gentlemen, this is not financial advice. I do not know your individual circumstances, but it's a counterbalance across stocks, bonds. They can be a little bit more volatile. And historically, gold has shown a low or negative correlation with equities, meaning that when the stock market tends to falter, and we know it hasn't done for a while, doesn't mean it won't ever do it, gold often shines. So it makes it a really good tool for managing risk and enhancing the resilience of any portfolio. But recent analysis have suggested that the optimal portfolio allocation, again, I don't know your personal circumstances, may be from 4% to as high as 15%. Yet remarkably, and I wonder why, the vast majority of asset managers today still hold zero or close to zero allocation. Let's ask ourselves why. I've got some fantastic speakers going to talk to you about that. But the liquidity of gold is unparalleled. Whether you hold it in physical form, through financial instruments like ETFs or futures, you can buy it, you can sell it in markets around the world. It's flexible, it can be converted into cash when needed, and it is a source of liquidity when it's not available elsewhere. But looking forward, and that's what we want to do as well, the nature of money and investments is really evolving. We are moving, as we all know, deeper and deeper into the digital age. Control by government is continuing. Cryptocurrencies, blockchain technology, they're all reshaping the financial landscape, leading some of us, some of you maybe, to question the relevance of traditional assets like gold. I never question it. But I believe rather than displacing gold, those new technologies can coexist and even complement each other in a diversified investment strategy, because it's not purely speculative gold, it's grounded in its physicality, its historical, monetary and cultural significance, and as I said before, its universal recognition. Now, in contrast, I am not against cryptocurrencies whatsoever. They do offer exciting opportunities, but we all have to understand they are still in their infancies, and that means they are subject to extreme volatility. So I look at gold as a stabilizing, a stabilizing force in uncertain times, and I think it does remain unmatched. So, as we all try and navigate the complexities of the modern financial world, I believe that gold will continue to offer that combination, if you like, of security, stability, and growth potential. Because it's a tangible asset in an increasingly intangible world. That store of value that's transcended millennia. Whether you're here as a seasoned investor or you're just beginning to explore your options, I encourage all of you to educate, to learn, to ask questions, and consider strategic advances of getting gold into your portfolio. It's not just an investment in the past, it's an investment to the future. It's the thread that has tied together the financial fabric of our world until the early 1970s, when we all remember President Nixon temporarily took the US dollar off the gold standard. Just temporary. Where are we now? 2024, interesting. But I believe that gold is now re-emerging to reclaim its central role. You just have to look at what's happening with central banks around the world. They are all buying gold more than they have ever done in history. This, my friends, is a time of rapid change. We need to embrace what's going on. We need to make sure that we understand how to protect and grow our wealth, and we need to help secure our families against future uncertainties. We've got a fantastic panel tonight, a panel of speakers that I hope are going to help you understand how all the different ways to hold gold. Can I ask who in the audience at the moment holds physical gold or silver? Probably about 20%, kind of like the fingernails on my hand, 20% silver, 80% gold. It's interesting, ladies and gentlemen, so many people don't pay attention to what's going on in the world. Why? Because you trust the paper that sits in a bank and has always done what it's always done. But I'm going to share with you tonight, and our panelists will as well, some facts, some understanding, which may actually shock you going forward. But I hope it shocks you in a good way. I hope it shocks you into paying attention. I hope it shocks you into taking action. And I hope it shocks you into understanding that your fiat currencies are printed, gold is money, everything else is credit. And now I'm going to introduce you to a fantastic panel of speakers. Thank you. First up, Mr. Michael Pepper, sponsor of this evening's event. Mr. Michael Pepper, founder of Bullion Now. Please join me on the stage. Thank you, Michael. Good to see you. Alexander Scanlon, he is the founder, CEO, and managing director of Barton Gold, the ASX code BGD. Alex. Jessica Amir, she is a market strategist with Moomoo, which is a trading platform. Each of these people have got exhibition stands outside, so when we get to the drinks, I expect you all to go and chat to these people. Please welcome Jessica. Mr. Nick Farr-Jones, some of you will know him as a former Wallaby, but I know him as the Director of Taurus Funds Management. Nick, please come and join us. Hedley Widdop, newly appointed CEO of Lion Selection Group. Some of you know he has the Lion Clock, which is a fantastic thing. Hedley, please join us. And last but by no means least, please welcome Jamie Hanna, Deputy Head Investments and Capital Markets for Van Eck Australia. Thank you, Jamie. So I'm going to come round the front because I can't see, otherwise I'm going to see the backs of you. What a great lineup, ladies and gentlemen. Now, I'm going to ask each of them, because some of you won't know who they are and what the hell they're doing sitting up here on a stage. So let's start with you, Mr. Michael Pepper, founder of Bullion Now. Tell us a little bit about Bullion Now and why you got involved with precious metals.
I've been involved in precious metals since I was fairly young. It was a hobby, it was an interest more than anything else. Pursued other careers and came back to Bullion many years ago. It was always in the background ticking along. And then we created another company called Little Coin Shop, which focused on numismatics side. And we found that people would buy fairly expensive coins at different times, and then they'd say, well, I also want to purchase some gold or some silver. So we'd refer them to other dealers, and our industry can tend to be a little secretive, for want of a better word.
Never.
And there was a general attitude out there that, you know, I don't understand and I'm not getting the service that I want. So that was reflecting badly on us. So we then went out and created Bullion Now to kind of fill that niche. And several years later, here we are. We are a Melbourne-based company, although we do service clients all over the world. And we deal in the physical side of bullion. So you'll hear several different opinions of people up the front here that invest in equity side of it or future sides of it and things like that. But we deal in the hard stuff, the physical stuff. And we encourage people down those sort of lines. So that's what Bullion Now is about. It's about providing that service. It's about providing the physical, but it's also about providing education, which is why we are very pleased to be here with Kerry sponsoring this, because we feel it's very important that we give back to that community and keep that education going out there.
I'll get on to you in a minute. Actually, just before we move on from you, Michael, why is it that you, because I often get people saying to me, oh yes, I understand all about gold, I've got some jewellery. And I go, oh dear. I know why that's not gold, but why do you think that people just don't get it?
Because it's not part of, there's many reasons, one of them being it's not part of the Australian psyche. If you talk to some in the Indian community or in some of the Asian communities, it is very much part of their culture, part of their society, part of their ethos, and it's the way they're brought up. We don't have that. We live in a country that is incredibly safe, incredibly secure when we look around the world. We firmly believe in digging it out of the ground, but then we pass it off, we sell it to the overseas. So from an investment perspective, it's not part of our psyche, it's not part of our culture, and it's boring, let's face it. You know, I
don't find it boring at all.
You buy, in theory, you buy a lump of gold and you stick it. We had a customer come in very recently. They'd bought gold back in the 80s, they'd buried it in a sock drawer, and now they were bringing it forward because they needed it. They hadn't looked at it for 30, 40 years. That's one of the great things about gold. That's one of the bad things because it is so boring. Whereas jewellery is flashy and exciting and all that sort of stuff. So that's,
and doesn't hold its value, jewellery.
It does not hold. It's probably more that it costs so much to create because it has an artisanal or a workman's, a craftsman's expense built into it. So you talk of its intrinsic value, its artistic value it doesn't usually, but can actually maintain its value or keep going up. But usually that labour cost in it, you lose almost instantaneously as soon as you buy it. So when you then try to sell it for its gold content, you walk into someone like us and we say, well, it's not only not worth what you paid for it, but it's not even worth its gold value as such, because we now have to purify the extra metals out of it to actually get back to its raw product that we want. So there's many reasons why jewellery doesn't tend to work, particularly in a country like Australia, which has high manufacturing costs.
It's a good answer. And by the way, ladies and gentlemen, we're going to speak for about an hour up here, and then I'm going to throw to the floor. So if you've got questions, hold them for about 45 minutes, and then we're going to get questions from you. This is going to be very interactive. I've got people with microphones, so we want you to be involved. And by the way, there's no such thing as dumb questions. I've asked them all in the past. So please don't be shy. We want you to get educated, and we want you to understand. Alex Scanlon, founder and managing director of Barton Gold down in South Australia, developing a gold mine. What do you like about gold? But you're also a financial economist, which I think is pretty interesting for you guys as well. So not only is Alex involved in developing a gold mine in South Australia, but he really understands the history of money, and he has some strong views about gold and silver as money, precious metals. Alex, give them a little overview of who you are.
Yeah, look, first of all, pleasure to be here. Thank you, Kerry, for organizing. So as Kerry mentioned, I'm the managing director and CEO of a company called Barton Gold. It's a junior gold developer on the ASX. My path to that role is probably a bit of a twisty, windy path, not a very straight line. My background is, my educational background is as an economist, mostly on the macro side. And I've sort of got about a 20-year history in principal investments, predominantly in private markets and focused on real assets. So one of the things that I was doing back in the early 2000s was trading real estate investment trusts in US markets, and then we shorted the markets in 2007, looking predominantly at home builders. So fast forward, I come to Australia, and 8 years later, I've done a bunch of stuff in mining, and I set up a private investment group. And really looking around the world in 2015 and 2016, I started to notice a lot of the same very troubling economic and financial trends that we had seen building up in 2005, 6, and 7, particularly led by credit, or pretty shaky credit, bad monetary policy, bad rates policy. So inflation as a risk was definitely on the radar. We also saw a number of sort of geopolitical events happening globally that were really cornerstone in many respects on essentially a message of deglobalization, right? So from a market standpoint, if you think that credit is already really bad, sovereign credit, consumer credit, corporate credit, already worse than it was pre-GFC, and you see very loose monetary policy that actually got very loose in its response to the global financial crisis in 2008 and 9, and then never got tightened up in practical terms. And to use a bit of a silly analogy, Western politicians, as we like to think of them, discovered for the first time that they could just start printing money rampantly and that nobody was really paying attention. So they just left the printing press running, and during 2009 to 2016 printed trillions of dollars that they pushed into markets. And when you do that, you create a tidal wave of liquidity. You're going to create at some point a tidal wave of inflation. So we were concerned about inflation rising. We had been specializing in my group looking at sort of 30-year trends and figuring out where do we position ourselves. Well, we started looking at this and we said, well, you know, gold in a tier 1 jurisdiction starts to look pretty attractive. And with the advent of Brexit in the UK and the presidential election in the US, this was sort of two leading Western nations, the sort of two leading Western liberal democracies that were kind of saying, we're going to look inward now, we're going to deglobalize, we're going to break historical military and trade relationships. I can tell you one thing for sure, and that is if you already have huge inflation pressures and you disconnect any trade market, particularly one that has been cemented for 80 years in the post-World War II NATO-led order, and we can have all kinds of discussion about whether that's good and bad and who did what right and who did what wrong. When you start breaking markets and disconnecting these markets and putting tariffs in between them, you create trade friction and you increase prices and you reduce the free movement of labor and people, goods, ideas, and prices go up dramatically. So you have guaranteed inflation. A tariff is essentially inflation imposed upon you by your own government as opposed to the competitive market. So bad credit, geopolitics, we really started looking at taking a significant position in gold. And about 7 years ago, 6-7 years ago, we essentially acquired a large, basically a large group of assets in Central South Australia that had been producing gold for 130 years, but had never really been consolidated and developed in the modern sense. So we're really positioning looking forward at that time, 10, 15 years, and many of the things that we were concerned about happening, in fact, happened faster, really spurred by things that were really unpredictable. I think conflict in Central Eastern Europe was very predictable. COVID was not, but COVID and the government monetary policy and response that came to that really lit a match underneath things like inflation and monetary policy issues that have been driving gold.
Scared yet? Should be. Inflation sticky?
Yes. Yeah.
Have we seen the worst of it yet, or are we just getting started?
I mean, I think in practical terms, we're really just getting started. You can't, I mean, a really simple way to say it is, if you've had $20 trillion injected into the economy, that tends to be passed through the hands of financial institutions because they can do what? A bank can hold $1 in reserve and lend $7 to $8 out against that $1 in reserve.
Yep.
Where does that go? That tends to go into property. That's where they can have that reserve ratio. So you get tremendous sums of money pushed into property, and it creates a huge lagged effect where only some period of time later does that start getting liquidated and dropped into the market. But at the end of the day, whether or not you look at it from the fact that it gets buried in fixed capital assets that are going to be made liquid at some point, or the fact that governments are printing that money to prop up their economies, you simply cannot unprint $20 trillion without destroying the world economy overnight. And the people who are making these decisions have at most a 2-year incentive horizon, and that is to get your vote again and keep power. And that's it. It's that simple. That's all that's driving them. Staying in power and, in many cases, staying out of prison. So that is, that is the decision-making paradigm that influences a lot of the things that really affect your life, which is why, why I'm very happy to be at a conference that is actually very investor educational focused and is actually talking about these things instead of just only being companies saying invest, invest, invest. There's really an opportunity to talk to everybody on the panel here, but around this conference, I mean, I tried to count it up. There's well over 1,000 years of combined exploration, development, financing, operation, refining, hedging, markets, and analytical experience at this conference. So there's a real wealth of knowledge, and like Kerry said, do dig in, because it's here for you.
And wasn't it interesting how easily the T for trillion slipped off the tongue then? Do you remember when we used to go, $1 million? Then we got excited about $1 billion. And now we're talking trillions of dollars, and it's just trillions of dollars. Jessica Ramir, market strategist. It's fantastic to have you here with Moo. Who knows Moo? Not enough of you, clearly. Jess, explain to the audience why you're here, what it is that you do, but more importantly, your views on precious metals, because I know you've got some views. You speak on channels all across Australia. So talk to us about Moo and also your views on precious metals.
Thanks, Kerry. It's a pleasure and honour to be here. So I'll start with the most exciting thing, and that's where I think gold is heading, and why I'm quoted in the media. So I'm a market strategist. I've been in this field, finance, for almost 20 years. So that's showing
Doesn't look old enough, does she?
Anyway, I was a financial advisor, and then I took a pause and I went into TV as a full-time reporter, and now I'm back. And so as part of my role, it's all about education, and I speak to clients and I speak to the media. So I'm often on TV, on radio, and in newspapers. And a lot of journalists are calling me of late asking why I'm so bullish on gold. And so I'll just pose a question to you all. Who knows how much the Aussie share market is up by? Raise your hands if you think the Aussie share market is up by 5%.
In what period of time?
This year?
Yeah, this year.
Oh, this year.
Talking year to date. Is it up by more than 5 or under 5? Raise your hands above 5.
It's
Keep your hands up if it's below 5. Cool. Okay, so the Aussie share market is up by almost 8%. Let's call it 7.6. Who can tell me, or have a ballpark guess? Raise your hand if you think some top tier gold producers who are digging money, who are digging,
Well, they are.
digging money out of the ground and selling it, making a profit. Australia's biggest gold producers. Let's just raise our hands and guess how much they're up by. Can I see a show of hands? Who thinks their shares are up by over 5%?
Oh, yeah.
10.
Oh, yeah.
20.
big
Nice.
ones.
25.
The big ones.
Nice. Yep. So the biggest gold producers on the ASX, in the ASX 200, are up by about 22%. Some by 23%. But if you're a trader or if you're an investor, gold is for you. You can have a look at companies, and we all know earnings growth drives share price growth. So that's what I talk to companies and talk to investors and media about. What about in the last 6 weeks? Where have been some of the best returns across the entire global share market? Raise your hands if you think it's from tech and AI. Oh,
it's
nice. All right. Raise your hands if you think some of the best returns, I'm talking global share market, have been from gold producers. Nice. And I suspect that's because some of you have been invested in some of these plays that are getting 70% return up over the past 6 months. So well done to some of you if you've been invested in those. So it's my job as a market strategist to kind of guide people through opportunities that are in the market over the short term for traders and over the longer term. And that also means looking at the different ways we can invest in gold, not just companies, also physical gold, but also gold contracts which you can trade on some gold or on some share trading, CFD, etc. platforms. And of course you can buy gold stocks, we've spoken about that, and gold ETFs, they're rising in popularity. But last but not least, short and sweet, my call on gold, which is kind of manifesting, is that if history repeats itself, gold could rally 100%. And it's not outrageous. If you take the average of the last 3 times the Federal Reserve has cut interest rates and you average that out, the gold price, if history repeats itself, which it never does, it probably rhymes, then the gold price could rally up 100%. Let's just say we take the last scenario. Look at the last time the Federal Reserve cut interest rates in 2019 from I guess trough to peak. The gold price rallied 35%. The 2 times prior to that, from trough to peak, the gold price rallied 157%, and the time before that 100%. So if you think that gold is for you, you're in the right place. And we've got lots of tips and strategies to help you. Thank you, Kerry.
Thanks, Jess. All right, well, we'll get back to you in a minute. Hedley Widdop.
Hello.
Hello, mate. Who saw Hedley last year? Couple of you? All right, well, Hedley's the CEO of Lion Selection Group. And Lion Selection Group, Hedley's very famous for his lion clock. We should have it up on the screen, but never mind. We don't this time. Hedley, could you just introduce yourself to the audience and your views on precious metals right now?
Sure. Well, first of all, thank you very much for inviting me, Kerry.
My pleasure.
I was worried you were going to ask me, why are you here, like you did with Jess, and I was going to say, because you told me I had to come.
I did.
Anyway, we've covered that. Whilst I think about what my answer is going to be, when Alex was talking and the trillions were rolling off the tongue, it just reminded me of if you think back to when the second George Bush came to power, I don't know if, I look around the room, I think most people here probably remember George Bush coming to power. It was an interesting market at the time. I'm just being respectful, I didn't say they're old. So in the first 3 days of his presidency, there was a catastrophe, a natural catastrophe, and there was an earthquake in South America, and 3 people were killed in Brazil. Anyway, someone comes into the Oval Office and says, President, there's been an earthquake and 3 Brazilians are dead. And he goes, hot bang, how many millions is a Brazilian? I don't know if that's more or less than $1 trillion. The monetary economists didn't cover that. So I work for an investment company based out of Melbourne. We invest in junior companies in the resource space. This company's got a 27-year history, and over that time, I think Lion has been involved in financing well over 150 companies from point of exploring and finding resources into being miners. I would say over 50% of those have been gold focused, so fair participation, I guess you'd say, in the gold equity market from that perspective. And you asked about the clock. So the Lion mining clock is a concept which we use to talk about the mining cycle. You'd be familiar with mining booms, and the corollary of a boom is a bust. Booms lead to busts, bust leads to booms. Mining is an extremely capital-intensive business, and because the tap of capital gets turned on and then off again, often in response to numerous stimuli, but global markets and commodities are two of the biggest ones. The mining market booms and busts. So we analyse that quite carefully, because it goes with it that if the market goes up and it comes down again, it gives you very strong buying and selling signals. So we manage this small company which is listed on ASX, and we went to cash predominantly, 90% cash in 2022. That was, in retrospect, the top of the market for most resources. So even the big indices in Australia are now off by about 12 or 15% since April-ish 2022. The space that we invest in, which is the micro caps, the explorers and developers, are down about 75%. So the purchasing power of that cash has gone up fourfold in that time. So we're now investing. We think that we've probably seen the worst of the liquidity coming out of the market. You can never say where the bottom is going to be for that kind of thing. You'll know when you're past it, but So we're investing, preparing for that. We've got about 50 million of cash, and all of that is available for deployment into investment. Did that cover all your questions?
I thought you were going to say all that's available for you, the 50 million. I thought there was going to be like an Oprah moment.
It'd be a pretty good.
Well, there is, because you can. It's an ASX listed company, isn't it? LSG.
Yeah, anyone can own a part of that. So
exactly.
LSX is the code.
LSX.
Yep.
Oh dear.
Hashtag LSX.
LSX. Tell me why you mentioned just then that you focus more on the sort of the micro cap and the smaller end of town. Why is that? Is that for leverage? And because a lot of people here would go, oh, I'm not quite sure about equities. That's a little bit risky.
It's an edgy space going into the explorers and developers. And I think a lot of people, well, I interact with a lot of retail generalist style investors, and generally speaking, attracted to the huge returns which you can get from an explorer getting it right. If you can make 100 times your money on a stock, that's very attractive, but it comes with the clear risk perspective. And I think the biggest blockages which people tell me about is their investment selection is blocked by jargon or a lack of technical understanding. So they sit there going, well, that sounds great, mate, but I don't know what it means, and if I don't understand, I won't invest. There's a high awareness that there's probably a fair concentration of versatile entrepreneurs, to use a word, in that part of the market. So, there's a trust issue for a lot of investors looking at that. And the boom-bust nature. I mean, an explorer is not a place where you can set and forget an investment. So that's what Lion was set up to be, is a set and forget investment into that space, so that we manage the investment going in and then coming out, and hopefully provide dividends at the end of the cycle. So it's the place where you can get the best possible leverage to an upward moving market that tends to correspond with upward moving commodity prices. And if you can sell at the end, then you can maximise your return from that. So BHP through the cycle, I think it bottomed out in January 2016 at $13. It's topped out in 2022 at circa 50. That's the return you can make through the cycle on the big fella. If you're invested in a junior, going from 10 cents to $10, it's not going to happen with all of them, but that is, that's the magnitude of difference. So that's why we're focused on that space.
Can go the other way too, ladies and gentlemen. Do your own homework. Thank you, Hedley. We're going to come back to each and every one of you. And by the way, if you've got a pressing, just stick your hand in the air. We'll get a microphone to you. Nick Farr-Jones. Well known for being a former Wallaby, but actually we've met many years ago when you were working with Société Générale in France. lately you, sorry?
We met 40 years ago, Kerry.
Oh,
You came to one of those colleges to us.
Not going to go
Anyone
there.
remember 1984, the Grand Slam Tour, as it was known?
Right, right,
Kerry
on
was
to
living in
Jamie
London,
Hanna.
came to
Jamie's
all
a
the
really...
matches.
Sorry, Nick, I was in grade prep. I wasn't allowed to go.
Let's just move on to your time at Taurus Funds Management. Why do we do that?
Yeah. Well, we can
Stop
go back to
laughing.
SocGen.
Let's go back to
That was-
SocGen.
That was my first involvement with gold.
Yeah.
And a terrific involvement. So, guys, the rugby days were all amateur, and I'm very thankful for that. So I was a lawyer. I studied law at Sydney Uni and had a decade in a mid-tier Sydney legal firm. And in 94, I had an invitation to go to Paris and join Société Générale, a large French investment bank. And the guy employed me was running the global derivatives team. So derivatives being, sort of hedging and options, and that was both precious metals and base metals. He asked me to come and try and establish our business both in mining, on the mining finance side, but also derivatives in Africa. You know all those countries in West Africa, prolific gold producers in Mali, Burkina Faso, Ivory Coast, Senegal, Cote d'Ivoire, and so also back then in 95, when I took a young family, Ange and I took a young family, South Africa back then was still the largest gold producer. They're probably now about the 10th largest. Back in the day, they had the largest gold producing asset called the Witwatersrand Basin, which basically ran out of production of gold in about the mid-70s. But it still produced down south of Johannesburg. And Johannesburg's one of the few cities that was actually built on a gold mine. Few big cities, sort of 3 and 4 billion people. So I would go down to South Africa quite a lot, maybe every quarter. Met the guys at the Rand Refinery, which is back then the world's largest gold refinery in Johannesburg or Germiston. They were running out of gold. It was built with a capacity of 1,000 tonnes. They said, Nick, you're French, you know that countries in the Birimian Belt in West Africa. Can you guys buy the doré bars, which are typically 94, 95% that get refined into the good delivery bars, the London Bullion Metal Association, 99.95% gold, which if you hold physical is typically what you'll hold, pure gold. They said if you can buy the doré bars, transport it down for refining, we can create a joint venture, which we went ahead and did. So back in about 96, 97, I helped set up a physical gold desk in Paris for SocGen. We soon after that found out that India is by far the biggest, or back then was by far the biggest consumer of gold. They have 10 million weddings typically every year. There is that gold culture of giving gold to the lady, but they're a huge hoarder of gold, and so we actually put in Tola bars, which is the 3.7 ounce desired gold bar in India, and we transported gold up to India under consignment and we sold it. So we had a great physical business. I came back to Australia to run the mining finance team for SocGen for a decade in 99, but as I was leaving Paris, I knew that India loved gold. My background, I had a knowledge that India loved their cricket, and I found out that they loved a bloke called Sachin Tendulkar. So we paid him I think it was $500,000 US to use his image for the 99 Cricket World Cup. We sold quarter of ounce coins in conjunction with an Indian bank called Corporation Bank around the world. We used a bloke called Devlin, who the platypus on our 20-cent coin he designed. I did it in conjunction with the Perth Mint, a wonderful South African guy who knew all about bullion. And we lost $1 million on that project. But it was a fantastic venture, and the organisations like the World Bullion Council and the World Gold Council just loved us for giving it a crack. And India, unfortunately, didn't really go past what's called the Super Sixes. Sachin lost his dad during the tournament, went back for the funeral. They lost to Zimbabwe of all teams and got knocked out earlier. But losing $1 million was a fantastic experience. It got me really fired up. It got me fired up, and the bank was okay. It got me fired up about bullion and gold. And so I now work for Taurus Funds Management after a decade with SocGen. Headley does the equity. We started doing the equity, but we found out that what's called the limited partners, the big pension funds, the endowments where we raise our money in the United States, we manage about $3 billion US dollars. They didn't like the volatility that Headley's just talked about in being equity investors. You can get your 100 baggers, but you also, in the current market, it can be very difficult. So we went in Taurus Funds Management to do debt mainly. We can do equity alongside debt, but we mainly do project financing, acquisition finance, typically anything from, we lend in US dollars, 40 million up to, we can do it about 250 million in a single underwrite. In that West African countries I spoke about, over the last 10 years, we've done about 1.5 billion of project and acquisition financing. We haven't done a lot in Australia, albeit Alex knows that we'd like to, at the right time, to project finance their project down in South Australia. The great thing, and let me just endorse Kerry's notes. As I said, she's a great friend. This is her 14th year. Congratulations, Kerry, and we love being here. The great thing about the resources sector, which I've nearly had 30 years in now, it's about 2 degrees of separation. So we all know each other, the brokers, the equity guys, the debt guys, the banks, the miners, the geologists, we all know each other. It's a fantastic space to be in. And endorsing Kerry's words, feel free to go and talk to people, guys. We'd love you to come up. I was recently at the Noosa conference, and a bit like your conference here, Kerry, there's a lot of mum and dad investors who've never really been involved in the sector for a while, and it's just great to get to know people, guys. We all love to talk to people over a beer outside, listening to Alex, your DJ, and thank you for sponsoring.
DJ Mike Dodge in the house.
But guys, feel really free to come up and have a chat and talk about it and talk about our experience and what you like. And, you know, we're here for 2.5 days. And so I really endorse what Kerry said. Meet people, get out there and understand the industry, understand the opportunities. And it's a fantastic sector, the mining, the resource and the gold sector.
Thank you, Nick. Last but by no means least, Jamie. Jamie Hanna, new dad. Hello.
Thank you.
So I just want to say first up, Jamie, thanks for coming here as a new dad, or it could be a relief, really.
It is. It is. My wife is at home doing all
the
hard work.
He said yes very, very quickly. Now,
happy to be here.
Jamie was here last year, and we talked. He's with Van Eck Australia. Now, Van Eck Australia, one of the leading companies with ETFs. Does everyone know what an ETF is? Exchange Traded Fund. Everyone know? Some of you don't. Okay, cool. Jamie, talk to us about exchange traded funds. A lot of people don't know what they are and why they should even have them as part of their exposure, I guess, to precious metals.
Absolutely. Thanks, Kerry. Look, I think we should kind of talk about why I'm up here too, because Van Eck launched, I guess, gold funds in the US back in the 1960s. And their fund is still running in the 1960s. And Van Eck globally, across every single gold company in the world, we are probably the top 3 shareholder in every gold company in the world. We run more than $20 billion in gold assets. That's US dollars, by the way. And so we have an in-depth understanding of the gold industry because we've been doing it for so many decades. Myself, I haven't been doing it since the 1960s, obviously. But you know, we have an operation in Australia. I was running gold funds in Europe before coming back to Australia. So an ETF is a way to access gold, and that's a gold equity or physical gold bullion. So you can actually buy the fund on the ASX, and it trades just like a normal share, like BHP or LSX or any of them. So there's really only, I guess, 2 ways that you can actually access gold in reality. You can actually buy the physical gold, and that means you could buy it through a gold bar, through jewelry, through any other way. But you can also buy it through an ETF. And that means you can actually buy the price of gold in an ETF, and you don't have to then store the gold bar yourself. So you don't have to insure it, or maybe not insure it and put it in your drawer and hope you don't get robbed. So the ETF, essentially, you would buy the ETF on the ASX. It's called NUGG, N-U-G-G. And for every dollar that we get, we go and buy a gold bar through the Perth Mint, and it sits held in their vault. And obviously we charge a rate, it's 0.25%, but that covers insurance. It's backed by the WA government. And because we're actually holding the underlying gold bar and safekeeping it for you, it actually tracks the exact price of gold. There's no other fees and costs, like we're charging the 0.25%, and that's really covering the shareholder register and actually maintaining a fund on the ASX. So it's one way you can actually access gold and the gold price without actually holding the physical gold under your bed. Now you can redeem physical gold too. So because we're holding the gold in a vault, you can actually contact us if you're a shareholder and redeem a physical gold bar from the Perth Mint. So it's fungible in the way that you can actually get it either through selling it for cash on the stock exchange, or you can physically ask for a gold bar. So it's one option. The other option to actually invest in gold is to buy gold equities. That's gold shares. Now, gold shares have inherently over the years been leveraged to the price of gold. And what I mean is that if the gold bar price goes up by 10%, then generally the price of a gold equity as a whole would go up by more, something like 20%. Now, the alternative to that is if the gold falls 10%, the gold equity could more than likely fall 20%. So you get a leveraged effect to the price of gold. Now, by and large, good portfolio theory, and if you're looking to invest, I know a lot of people like to buy actual physical gold bars, and nothing wrong with that. But over the long term, it's generally shown that if you have a mix of gold, as in physical gold, and a mix of gold equities, you tend to pick up a little bit more when it's going up, and you tend to lose a little bit more when it's going down. Now, where we are right now, the gold price, as anyone who would have looked, you're probably in this room, it's over $2,500 an ounce. It's at all-time highs. But for the first time in at least the last 20 years or more, there hasn't really been a sustained increase in the underlying equities. So what we've seen is the gold price is up over 20%, yet the gold equities are only up about 20%. Now, if we actually drill into it, and I know there's a lot of analysts here, the price that these gold mining companies get their gold out of the ground across all the companies in the world, not the small ones, we're talking as many as we can actually manage, they get it out of the ground for around $1,400 US per ounce. So we're well above that at the moment, which means that for every dollar that the gold price goes up, the gold mining companies that are actually already mining gold is actually just extra profit to them. But at the moment, their share price hasn't moved. So it indicates one of two things are happening. One, either the gold price is too high or the gold equities prices are too low. So over the years, they've always met in the middle. But at the moment, there's a big disparity between the price of gold and the price of underlying gold equities.
Well, that was... does anyone want to have a right of reply to what JB just said about... I can see Hedley itching a little bit there.
I'm always fidgeting, Kerry.
Yeah, that's true. Any questions from the floor as well? Well, have we got microphones? Can we have one just down here, please? Just wait for the mic. Just before we take that question.
Kerry, just a quick thing for people who are new to gold mining.
Yep.
We mentioned the price to produce gold is about $1,400 US. That's what's known as all-in sustaining costs. So you've got operating costs, but it's all your costs, all-in sustaining costs. And what gold miners are really focused on is producing that margin. So being really low-cost producers in a very high gold price environment, there's a whole bunch of gold producers that are either big gold producers or mid-caps that really focus on trying to drive down their costs. But in inflationary times when employment costs are high, when building a project, sustaining capital that goes into your annual cost to maintain your plant, to do your additional sort of exploration to build your resources and reserves and mine plan, it all goes to what's called all-in sustaining costs. And for the mid-cap and the seniors, that's around about $1,400 US currently on average. And so at 2,500, as has been mentioned, that's your margin.
Yeah, per ounce.
Per ounce, sorry.
So we've heard that either the gold price is too high or the equities are too low. We've heard earlier that gold may potentially have a long way to go, more of a run. So what's preventing, in your view, the the equities prices from going up?
Should I start, Headley, or do you want to?
Oh, you go for it, Jamie. Yeah.
Look, there's never a clear reason. Let's start with that. It's a very good question. Momentum generally drives a market. So to drive a share price up, people need to be buying, and more people need to be buying than what are selling. It's just straight economics. And at the moment, there isn't enough interest in gold mining companies to drive the prices up. You can look at all the fundamentals you want, the return on equities, the earning per shares, and all these technical factors, and I won't go into that. But where you sit at the moment, not enough people are buying gold equities across the board, and that's from mums and dads, and that's from institutional investors as well. So either they see it as too risky, or they see it as not a great opportunity right at this moment. But that said, there is a disparity right now. I certainly am not saying that the gold price is too high at 2,500. There's so many geopolitical risks, and I'm sure the other people can talk about that. But gold equities are lagging. They're just going to print bigger profits. They're going to print higher return on equities because they're just essentially making more money because they're all in sustaining cost. The exact number we calculate across our holdings is about 1,430. So they're making nearly $1,000 per ounce they dig out of the ground. That can only be profit for the company. And in the long run, something has to give to bring these two into equilibrium.
But Headley, it's probably worth talking about the non-producers.
I'm only talking producers.
So the companies that are exploring and what have you, and they're the ones that have really been beaten up in the last couple of years, as sadly you would well know. Well, and from my perspective as a debt provider, part of the problem is when your market cap remains low, the market gives up on you because, one, it's difficult to raise additional equity when you need to continue to do your study work and your additional exploration. But a lot of punters out there will say, well, typically the maximum debt you're going to be able to raise is about 60-70% of total capex to build the project. How on earth are you going to raise the 30 or 40% equity when your market cap's $40 or $50 million?
Yeah, so I think to tie in a couple of those concepts, but also just to address the question, which was gold price has gone up, why haven't gold equities gone up as much? And I think there's a couple of things behind that. The first one I would say is that there has been a long history of capital destruction in the gold mining market, which has set a lot of bad precedents. There's been some delightful precedents as well, but if you take $10 off of an investor as 10 different companies and 7 of them rip it up and turn it into smoke, there's a trust issue, and that has been a problem, I think, in not just the gold industry, but there's a history of so there's this will I, won't I, where does my capital go? Do I put it in, and if you're an equity investor, it can go into tech, it can go into gold miners, it can go into a company that makes ice creams and sells them. All of those things have different risk profiles. And I think it's also worth pointing out that at the moment, if you're an equity investor and you just go, well, what's made the best returns recently? Tech is one place that's probably robbed a lot of risk capital, and people who've got all their money in banks and supermarkets, that's not risk investing capital. That's a less risky equity investment. So I think that money sloshes around in a risky space into tech and flows into commodities at other times. And I think we're sitting at the moment where a lot of money has gone into tech and it hasn't come out yet. Jess, I think, mentioned tech investing before and how much had gone into that. NVIDIA is a company which I had never ever heard of until about 12 months ago when AI became a thing. And AI is awesome, right? I mean, you can make videos of yourself saying stuff that you never said. It's incredibly useful like that. Andrew Forrest certainly thinks it is. NVIDIA has gone up by a tremendous amount. It was the biggest listed company in the world for a period of time. NVIDIA's come back by, I forget what the percentage is, but it's leaked US $900 million worth of capitalisation just in some of the heat coming out of its price. That's 3 times the value of every single listed mining company in Australia that's listed on ASX. So, you take a whole industry, multiply that by 3, that's how much money came out of that one company. So, there's a relevance issue as well. Does the money flow into that tiny little part of the market? Maybe it does, maybe it doesn't. But the final thing I would say is that the one behaviour which is absolutely consistent when the gold price goes up is that costs do follow, and you have this difference between all-in sustaining costs and the gold price, which could be profit, and a lot of times that becomes the capex that gets spent the next time around. So if you were to look at cash flows of these companies and how much they make in a year just on basic cash flow and how much reports to an increase in the cash balance, you'll often wonder about what the disparity is. And I think that probably explains the underperformance in some years, and now is no different. It's a very, very heavy capex cycle going on at the moment, and that's probably a reason.
I'm going to come back to basics in a minute, but I just saw someone wants to ask another question. So let's keep the questions coming from the floor, because it's all well and good. Yep, got you, Andrew. It's all well and good us sitting here up here talking at you. We want you to tell us what you want to know. And it can be as simple as, what's the difference between silver? We don't care, but we're here to help you understand more. So please keep the questions coming. Next is this gentleman.
Just an observation based on what Jamie said about how the physical gold price has divorced from the price of gold miners.
Yep.
The most logical reason that I've heard is that, and it makes sense to me, is that this time the driver of the physical gold price is different to previous cycles. So whilst previous cycles, the drivers were other drivers, in this particular cycle, the drivers being the central banks. And the central banks are the ones that are pushing up the physical gold price. They don't buy gold equities. So while China and the others have been piling in and pushing up the spot price of gold, Western ETF flows have until recently been negative, and there's been very little interest from the retail investor who typically goes into a mining stock. And then obviously as the profits start increasing, they'll get more attention and that'll fix itself.
Is there a specific question that you wanted to ask any of the panel? Because I want to come back to you on your price analogy there, but is there a specific question?
No, just whether Jamie's also, because this is something Rick Rule always mentions, that the gold price is driven by the central banks, Poland, Turkey, China, whereas these guys don't buy miners.
I think the gold price, and any of this panel will probably correct me if I'm wrong, I think partly the gold price is driven by reckless printing of your paper by governments that are spending like drunken sailors, can't help themselves. You can't print gold, and paper isn't backed by anything. And I don't think it's the gold price going up. I think it's the purchasing power of your paper going down. Michael, do you want to make commentary on that? I know you and I have had part of this discussion in the past.
We can go way down a rabbit hole on this one. There are so many branches to this rabbit hole, it's not funny. I mean, we haven't touched on the weaponisation of the US dollar yet.
Nope.
And how they've, you know, if the, I'm massively generalising here, but if the Americans don't like what you're doing, effectively they say, as they did to Russia, you know, well, you can't use our dollar for buying assets around the world or for trading. You know, they do that once or twice, and the rest of the world turns around, and we're seeing that in China, we're seeing that through a lot of other places. They turn around and say, well, why would we keep our reserves in US dollars if they're going to turn around and do these things? We need to stock up on an alternative. And the only real alternative that is out there for central banks is gold, as of Basel III. So, you know, how far down this rabbit hole do we want to go? I don't think...
Not too far, we've only got an hour.
I go back, I mean, I'm 51, almost 52, and I go back through the history of, like the relatively recent history. Gold's been around for 5,000 years as a money source, but I don't think I've ever seen so many various drivers pushing both the demand for gold but also the price of gold. And they're so varied and they're coming from so many different angles, and it's not so much investment only where we see it flowing into shares, but it's also these end-use cases more and more and more. So to me, that's a lot of the reason why we're seeing a lot of the drive up in price in the physical side of it rather than in the shareholder side of it.
I know Alex is ready to go, ready to unleash. Go ahead, Alex.
Well, I think that Michael jumped on really one of the the key points, which is the question of why are central banks driving gold. And so my personal view is that the single greatest tailwind that gold has is essentially a desire for countries all around the world to return to essentially a pre-US dollar hegemony model for trade, right? So the idea that the US dollar is a safe haven reserve asset has been heavily entrenched in all of us simply by our lived experience, right? In 1971, US dollar comes off the gold peg. In 1973, the petrodollar agreement, as it is called, was basically a military security alliance that also said, well, we'll look after you, but why don't you make sure that the global energy market is based in US dollars, because, well, that means that all markets will become US dollars, because I mean, it's fluctuated over time, but today the combined energy market is something like 30 times larger than the next largest market. So wheat and iron ore are $300 billion markets. The energy market is a $10 trillion market. So as energy markets go, so too will go everything else. Going to Michael's point, I sort of look at March 2023 as a very interesting apex point in history, and I think it will prove to be something that people isolate in history books and look at a very tight period of time and say, that is the spot where we pivoted. In March 2023, Xi Jinping gave a very forceful speech, essentially lamenting the great shame and bullying wrought upon China and its historical empire in the period from sort of 1840 to 1945, so this period of colonialization and war, and this is a point of great aggrievement for China, historically, culturally. Now, China is one of the so-called BRICS countries. The BRICS countries, the BRICS Plus as they're now called, and then the BRICS Plus, there's sort of 40 countries out there that are now milling around. And I think one really important thing to understand about these countries is they're no longer just these tiny little developing countries. They are pissed off teenagers rebelling against their parents. Right? They can get together now and move markets and make decisions in ways they could not in 1982 or 1983 or 1999. So March 2023, Xi Jinping gives this speech. March 2023, Australia, the United Kingdom, and the US announced the AUKUS treaty, put US, British and US manufactured nuclear submarines in Australia. What does that do? Well, that puts China on edge because they see that as a policy of containment. March 2023, the very serious talk about actually seizing Russian treasury assets ramps up. March 2023, the US seizes $58 billion of oligarch money as a shot across the bow. And then in March 2023, China settled its first ever gas deal with the UAE in renminbi, all right? And then in the same month, they mediated or moderated a military security and energy pact between Saudi Arabia and Iran. Sort of like, so the deal being, you guys are two of our primary energy suppliers, we'll give you security. Sounds an awful lot like petrodollar, right? So we've come kind of full circle in 50 years, almost exactly 50 years, where there is for the first time a credible, sustained effort by a large enough slice of the world, which, by the way, produces and consumes over 60% of the world's energy, to say, let's de-dollarize energy, or our portion of it. Let's take that power away from the US Federal Reserve. The only way you can possibly de-dollarize any quantum of that market is to agree on a neutral reserve asset that everybody can accept, that's fungible in every currency. And the idea of a BRICS euro is a nonsense. To be frank, these guys don't trust each other. They will never share central banking or monetary policy. They do not want each other's low quality currencies, right? We are returning to a world where we are entering into bilateral multi-currency trade. I send you wheat, you send me iron ore, I buy cotton from Jess, she gives me gas. We are moving everything around. Bad example. But we...
Just an unfortunate analogy.
Where do you want to be?
Nothing to see here.
We move everything in circles, but we all have a surplus of somebody else's currency of 3 to 5%. That's getting settled in gold. That will be settled in gold. And if you were to settle 5% of the BRICS energy market in gold, you're talking about $250 to $300 billion a year worth of physical gold that has to be delivered in custody around the world. That is how much gold we produce in a single year. So now all these central banks, particularly those who do not have a natural comparative export advantage, i.e. something they produce physical well that they can barter with or trade with on a swaps platform, they have to stockpile gold really, really, really quickly because they have to make sure they have multiple years of the gold that they need to settle the net currency surplus on their energy trade, because if they don't, if you don't have energy, you do not have an economy. Your lights go out, you are gone tomorrow. So gold is the only way you can de-dollarize energy. And I actually think that is why we're seeing this sustained push. We're seeing a disconnect from what's happening in real markets. People are yet to really wake up to this, but I think that's why we have such a full room here. I think everyone here has started kind of reading about these things, and they're real.
I agree with you, and follow the money, follow the central banks. What are they doing at the moment? I think I saw, was it Andrew? Okay, we've got Andrew first, so just pass the microphone along, please. Then we'll come to you, sir. Can I have another microphone down the front here, please?
I was just wondering if an explanation might be for the poor performance of gold companies, that one, there hasn't been much M&A, mergers and takeovers happening on the big end or even on the middle levels, and that might get going. And then the other thing might be the actions of governments stopping projects. We won't mention which ones in particular, but the dead hand of government, both state and federal.
Oh, who wants to have a go at that?
Can I just tackle a bit of that and combine?
We're talking really why haven't I think M&A is starting to happen. I mean, we're already starting to see it, but yeah, please tackle.
Yeah, absolutely. M&A is definitely happening. If we have a look at that, for example, BHP buying 50% in that smaller Argentinian copper play, but that's beside the point. But if we think about why gold companies have not yet moved yet, yes, indeed, they've moved up off their lows, but just touching on why this time is different. So combining momentum and earnings growth and earnings revisions, that is by far and probably will always be what drives share price growth. So earnings growth and earnings upgrades drive share price growth. And the tide is going to change and bolster. And we're starting to see that if you just have a look at the world's two biggest gold producers, Newmont, Barrick, we saw exceptional, better than expected results and earnings upgrades. And so this is why the tide is also changing, and why we're saying, and I'm saying, gold producers are heavily undervalued, and is the gold price, if you want to value the gold price. But why is it undervalued, and why are investment banks, including not just ETFs, but actual investment banks, are physically stocking up on gold? And they're putting their, they're actually buying some exposure into the world's biggest ETF. The physical buyer of Spider is actually, I forget the ticker, but the world's biggest holder of gold is an ETF. It's got about $77 billion of funds under management now. And so it's just starting, and ETFs and retail investors alike are really only just starting to accumulate gold producers on the notion that we're going to see the tide change with gold. And going back to Alex's point, there's a couple points to this. So the depreciation of the US dollar is going to push up the price of gold. Obviously, we all know they've got an inverse relationship. And that is going to gain momentum because the Fed is going to embark on a cutting cycle, the first in many years, and that is going to devalue the USD, and of course, mamushka, up goes the gold price. And that again will drive earnings growth in some of these smaller gold companies that have not seen the light of day as yet. But the tide really is changing. Don't forget geopolitical tension, central bank buying, and don't forget the PBOC is continuing month on month to stock up on gold. So this time is different. Gold producers are heavily undervalued, and their time will come.
And the PBOC is encouraging everyday citizens to hold gold in their accounts. That is being heavily encouraged. Gentleman here, if we got a microphone, please. Just here, gentleman in the blue shirt. Then we'll go to gentleman towards the back there. Oh, with a young man there. Okay.
My question is for Jamie. I think, Jamie, you mentioned that you buy the physical gold for ETF investment. So I got two questions. Like, first is what percentage of that money will go into the actual physical gold? And second is like, how regulated is that, which like normal mom and dad can trust? Instead of buying $1,000 worth of gold coin versus buying $1,000 of ETF.
Yep. So firstly, to the second question, every cent that we have or get, every dollar we get, we buy physical gold, right? So everything is invested 100%. We buy that through Perth Mint. So our gold bars are what's called Australian origin gold bars. So that's only from gold mines in Australia. So we don't buy any gold from, well, Perth Mint actually don't acquire any gold from any gold mining places outside of Australia. So it keeps what we think, it gives an Australian exposure to Australian gold, because a lot of other gold ETFs will hold Russian bars or, whatever bars from around the world. So to keep it simple, when we buy it at the LBMA price. That's the London Bank. It's a standard time of the day. It's a PM rate. So we just buy it through every cent that we get in. It's no more complicated than that. But just to add kind of what we're talking about, central bank buy a lot of gold, and people monitor that. But people also monitor ETF holdings of gold, because we're talking hundreds of billions of dollars worth of gold now are in ETFs. So they're big buyers. So when you talk about buying $1,000 or $500, it doesn't matter. We then have to go and buy gold because you bought it, you bought the ETF. So we're obviously also influencing the price of gold, because we're now, ETFs in general, I'm talking me as the ETF industry, we're buying, in some respect, astronomical amounts of gold, which has obviously put some pressure on the gold price. But more recently, this year, the flows have been less than other years. So less people have been buying gold ETFs.
What do you put that down to, Jamie? It's just
My personal opinion is that people think the price of gold is too high.
Ha! They ain't seen nothing yet. My opinion, that's all.
There's an opportunity to sell at a good price.
Yes. People are sitting on a lot of capital gain. If you bought this already, you've already got quite a bit of profit. And so people aren't really topping that up.
Interesting. Now, gentleman just down the back here. Thank you. And by the way, I'm seeing some little people in the audience. I love this. Next generation, getting learning. Little girl down the back there. Yes.
Thanks, everyone. My son actually introduced me to gold and silver last year on a project. So.
How old is your son?
13.
What's your son's name?
Abdul.
Abdul, you're a genius.
Yeah, so.
Give Abdul a hand. Well done, Abdul. Love it.
So his question is in regards to silver. So the last 2 years, silver's gone up from a low of $26.28. Now it's at all-time high. It went up to $48.65. Now it's around 44.
43, 44, yeah.
43, 44. What do you see your projections for silver? Because the demand for silver's gone up. I know this is a gold conference. Not everyone's going to have 3,000.
No. It's actually we call it the Australian Gold Conference, but really it's about precious metals. So we do look at silver and gold. It's precious metals, and Michael can speak to that as well. I know I'm wearing a gold jacket. I nearly put my silver trousers on today as well. It's a balance. I have 20% of my fingernails are silver and 80% is gold. That's about the ratio I have with gold to silver. But in terms of price predictions, I know I'd never like to go there. Michael, do you want to?
I hate going there.
Yeah. Yeah, I do too. Does anyone want to grab a hold of that?
Can I twist it round a bit?
Yeah, because that's what we need to do.
Well, I think it's an excellent question. Yep. Congratulations, Abdul, for your interest as well. What was the project on?
Was that school?
School project?
School project. It was talking about like currencies and then, the history of, from paper money. Obviously, before that, people were bartering.
Yep. I bet they didn't teach much of what we're talking about.
Yeah, he did it himself. He told me about it.
No, they didn't. But we are actually going to be getting a few students in. But yes, Headley.
So you do get. I mean, there are times where you see gold moving and silver starts to move as well. I mean, you can look at correlations over long periods of time, and you'll probably wonder if they're correlated or not. Silver, at the end of the day, is something which has an investment value. There are bar hoarding uses. But it also has a value in use as an industrial metal, and which means that if you use the example of copper versus gold, and now not nearly as much copper gets hoarded for those purposes. Most copper gets used in an end use, so it gets produced. An end user has to buy it and then put it into power lines or pipes or whatever else. There's a pain point that comes with that. So at a point, a commodity can become so expensive that the buyers step back, and you see that starting to moderate the price if you're watching it closely. Gold is unusual as a commodity, and there are degrees to which different commodities have this. Silver, I would say, has far more pain in the price points for people who purchase it for its value in use. Gold doesn't. Now, gold gets used in things like jewellery. And I've experimented with the substitutability of gold in jewellery. It's a statistical experiment on one person, and she didn't appreciate it when I tried to
his wife?
substitute something else.
Like lab-grown diamonds, don't go
Yeah,
there.
no, it doesn't matter how glittery it is. If it's the wrong colour, it's no good. So,
What about if it's white gold?
well, yeah, I tried that, but she was too smart for it. So, very intelligent, my wife. Gold doesn't have a value in use to any extent close to all the other commodities. So if the world wakes up tomorrow, or more to the point, let's say 700 million middle-class Chinese consumers wake up tomorrow and decide they want to buy gold, there's not a price at which many of them will step back if they're motivated to do it. Whereas if they were all deciding to buy copper, there would be a point where they'd go, no one's going to buy the wire off me for that much. I'm just going to wait until it's cheaper. So I think that explains to some extent the difference. Now, I haven't given you a price projection in that. All I'm saying is that gold, I think, can be uncapped. When it gets away, it will surprise you. Silver, I suspect, will probably underwhelm, because if you say, I think it's going to go this high, it won't. And if I tell you a price, it definitely won't get there. So,
And I'm the same. Don't ask me for prices either. But
maybe we point out, at the moment, gold is linked to the price of interest rates around the world.
Yep.
And interest rates at the moment have potentially hit a peak, certainly in the US. A lot of the market in the US at the moment is expecting up to 1% worth of interest rate cuts in the US. Now, this is a correlation, and that means it moves, but in the last 3 rate cutting cycles in the US, between 250 days and 500 days after the US started cutting rates, gold rallied quite hard. Now, that doesn't mean past performance is the indicator of future performance, but there has been a strong correlation in the past to interest rate cuts in the US and the increasing price of gold. So, just food for thought.
Michael.
I say this as someone who's very bullish in platinum, seeing as we're going to say we're a precious metals conference. Platinum's probably takes silver that stage further.
Yeah.
It's almost purely industrial use, whereas silver's 2/3 industrial, 1/3 investment grade. But as humans, and I guess I'm just trying to put a human spin on a lot of this, as humans, when we panic, we run to gold, we don't run to silver.
True.
So that comes to the driving of the price. When we panic, we tend to not care about the price we're paying. Silver, we don't panic and run to silver, so that has that limit there. We also, and a lot of the guys, Alex particularly, would know more about this than me, that silver is also a byproduct of a lot of our mining production. We mine for gold, we find silver. We mine for copper, we find silver. So there's almost a degree of no matter what price it goes up or downwards, we'll always produce silver as a byproduct of our operations. So there's less, there's an easier supply and potentially a lower demand use for it, which can impact on how much silver will move.
Alex is giving me that look which says, I want to answer this, so I will let him go ahead, and then we're going to go for more questions.
Well, I'm very far away from any kind of expert in silver, but I'm going to be very careful answering this question. I actually just wanted to kind of emphasize kind of a cross point from the conversation with the audience before and then what Jamie was discussing. I think one of the really big things that ties all of this together is that whereas traditionally in what we've learned in a US dollar dominated market is that gold is essentially in the short term driven by the US foreign exchange rate. On a daily basis, you can say what's going to happen to the price of gold based on how the US dollar is fluctuating. On a medium term basis, it has traditionally since 1970s, early 80s been tied to US interest rates. But what we have seen over the past year with these sort of very real transitions we see happening in the real market is that the last 2 years, rates have gone up and gold has gone up. So that relationship has been definitively broken, at least for a while. We don't know if that's a sustained thing, but it has moved so far outside of the historical correlations that something else is driving it. And when we think about where can the gold price go, where does silver go as a correlation, I think one of the key points coming back to your point, what we've been discussing is the people who are buying gold, central banks, are price insensitive buyers. They are policy buyers. They have made a decision, we have to have this much gold. When people who do not care what the price is say, we have to have it, that's a good thing to have in your pocket. So that's my addition to that.
Right, now I know we've got lots more questions. Gentleman at the back, and then we'll come to you, sir. It's Ken.
Yeah, if you go back to the mid to late 70s when I was just a boy and, with a quid in my pocket thinking, where will I invest some money? And you look at gold and you trot down to Jackson's futures brokers and you play the futures, which were on the Australian market. Fast forward 50 years, and while I still think I'm a boy, the young people nowadays, they go to Bitcoin. You talk about gold and they look as if you're stupid. And Bitcoin has massive rises. I mean, it has 50% pullbacks. What do you think is the tipping point that will make young people, where there's a lot of cash going into Bitcoin, to come over to precious metals?
I think that's an excellent question that I'm not going to answer. I'm going to throw to the panellists. Jess, go ahead.
So I work for a trading platform, so we're the biggest.
Is Jess's microphone on?
In Hong Kong and Singapore and Malaysia. So why am I expecting that question?
Jess, they can't hear you, so just give us half a second. It's just kinked.
I can talk.
Are you calling her kinky? Hang on. Apparently it's kinked. I don't know what that means. No, you can come up. It's a very relaxed audience, aren't we?
Do you want me to define kinky for you while you're sorting this out?
No.
Kinky.
No, we don't need your input.
Poor Jess. Poor Jess.
It's different.
There we go. Poor Jess. Be kind to Jess. Right.
Well, what? Oh,
no, she's good now. She's good now, I think. Maybe.
I can speak loudly. What I was going to say was on our trading platforms, by far we are not seeing our younger demographic, and the majority of our consumers are 35 and under. And we actually don't see anyone buying gold. No gold equities, no options, but overwhelmingly people are just momentum chasing. But I think the time will come. We've been speaking about the time will come, momentum will come, earnings growth, earnings revisions drive share price growth.
The time will come for gold. It's just not as illustrious as the younger generation would want. But I dare say it's also part and parcel with the Australian media as well, playing a big part. But I think the time will come and it will shift and change, especially once the Fed starts cutting rates and the US dollar will continue to depreciate.
But it is a really good question, isn't it? Because I think there is that challenge with that younger generation that You know, they've grown up with technology and they've grown up with phones where, you know, they can tap-a-roo and they can look and they don't like the physicality of gold, and it's too old-fashioned for them. That's what I'm feeling. Do you think that's going to change, Jess? Is that what?
Oh, I absolutely think so. I think a big part of our job as market strategists, or I guess we're all educators, is to tell people how they can, I guess, fish for themselves. Our job is not to tell people what to buy. I guess no one up here wants to be an advisor. We're not really happy to call out where gold will get to. I'm happy to, but no one's going to tell you what to buy, but our job is to teach people how to fish. And one of those jobs in teaching people how to fish is to know where you get your returns from. So momentum, the leaderboard, looking at who is producing the best return in the US market, in the Aussie share market over the last 1 month, 6 months, etc. And in the leaderboard, of course, are gold producers. So the younger generation, some kids, some of my friends are going to start to wake up and realise that. And the time, I think the time will come.
Time has come. Time has come. You can jump in, Michael. That's what I like about this. Jump away.
I guess my response to Jess actually right now would be that the future's here. There was not a time not that long ago where I was the youngest person in a room buying gold. And I am nowhere near that anymore. And it's not just the fact that I've aged a couple of years. We are seeing coming through our doors buying physical gold and silver. We are seeing a very large movement towards younger people doing it. They are more transitory, I think is the wrong word. They are happy to trade in and out of gold between a lot of the cryptocurrencies and back into gold again. They'll certainly pull their profits out and put them into gold, but we are seeing people, teenagers that are 13 as well, but we are seeing that 18 to 25 demographic up hundreds of percent over what it was even 2 or 3 years ago. So I would say, I would dispute the fact that the younger are only going into the cryptocurrencies. I would say from a physical perspective, and I can only talk from a physical side, I don't move in the paper circles so much, but from a physical side, we are seeing a lot more younger people moving into the precious metals. They are quite happy to move across the whole spectrum. So, you know, gold, silver, platinum, palladium and rhodium. The last two being a little iffy in Australia because of GST laws, but particularly across the first three, we are definitely seeing them move in. They're showing no signs of stopping on a physical side.
So Michael, if I could just ask a question. With your business, do the youngsters or do your clients, how many would take actual physical gold and hoard
All of
it?
them. All of them.
They actually buy the physical gold. But do they store it? Do they store it with you, or do they put it under the bed?
Some of, I'm not going to say where they put it, but some of them
they put it in their piggy bank.
With us. But
I was wondering,
80%.
I thought a lot of people would come in and buy like a bank account.
No.
They'd have their bank book and they'd buy ounces.
80% of our customers would walk out the door with some form of precious metal in their pocket.
So typically a coin or a bar?
Typically a coin or a bar. We don't deal in jewellery at all. But absolutely, and they store them in all sorts of places, and sometimes they tell us, and it raises a few eyebrows. But usually we encourage them not to tell us, because obviously that's one level of security.
Absolutely,
is don't tell
anyone. We don't want to know. We don't want to know.
But can I just ask? So what you're also saying is, after the gold price appreciates in value, they like come back in and they're like, I want to lock in my profits. I want to sell it. They'll sell it back.
Yeah, they will. They'll lock in profits from selling or trading cryptocurrencies. They'll bring it into gold, and then it's not. I don't say they roll them all straight out, in because quite a lot of them will hold their profits in gold longer term because they know the stability of it. But a number of them will also come in and sell a proportion back because they want to roll back into. So they will use the physical gold instead of using a bank account. They will hold physical gold because they know it's. One thing I would say about the younger generation is that they're more open to education. They don't go to the stockbroker that they, that 20, 30, 40 years ago that we would have gone to, and, the stockbroker that mum and dad dealt with and, granddad and grandma dealt with, they're quite happy to do their own research. So they will do their own research and they will take money from the banks and they'll hold it so they can be their own bank, if you like.
All right.
I just say, oh, actually, sorry, that's a really good point for everyone who is investing or trading, like all of us up here. We always lock in our profits. So as much as you don't want to say it, sorry, I don't know, I might be speaking out of school, but I love just reflecting on that. I think it's wise to also think about taking some cream off the table. And then if there's a pullback, which we all know markets, whatever, doesn't go up in a straight line.
Yeah, you don't go broke taking a profit.
And then you can put some of that capital back to work if you see a little bit of a pullback. So very wise.
All right, we've got a lot of questions out here. I want to try and get through them all. Next up, we've got, is it someone just here? Gentleman here, blue shirt. And then we'll come to you.
Thank you, Kerry. Look, it's more like, I just want to understand from the panel, are we going to go back to a gold standard, gold-backed currency, let's say? You've got China as the #1 producer. You've got Russia as equal second with Australia. What's stopping the BRICS nations from saying, hey, we want to go gold-backed? As was mentioned, I think Henry Kissinger's petrodollar is no longer. You've got Saudi Arabia pulling the pin. Now you've got BRICS plus. And as a supplementary, who should go first? I mean, well, who could go first? Would it be the West or the East, going back to maybe a gold-backed currency?
Who wants to take this little
Alex.
rocks up?
Yeah,
That's an Alex. It's directly to Alex.
So look, it's a very good question. I personally don't think it's practical to go back to gold-backed currency, just because, unless you want to do one thing, which is essentially a global revaluation of gold for the purposes of what would be referred to as a debt jubilee amongst the sort of more energetic discussion circles in this space. But the amount of, if you want to go to gold backed, you have to physically declare, you'd have to get a strong enough central bank or reserve to declare, we mark gold at blah and we exchange our paper for that value. There's a lot of conversation now that the US government has the ability to do that. It is an interesting question who would go first, because all of a sudden the geopolitical competitiveness comes in. Well, we don't want to revalue gold because all these guys have so much gold. But the US in theory would be best served, if it has all the gold it claims, to be the one to do it, because it would suit them the most. Right now, the global south and so-called eastern nations of the world are absorbing as much gold as they can. There are active premiums being paid and traded on the open market, pulling physical bullion from sort of west to east. So I don't think that you see a gold-backed currency, but I do think that the effect of settling trade surpluses for swaps-based trading platforms effectively does the same thing. You'll see a relationship between the physical quantum of gold and its value and the physical real value of products being traded will settle into some kind of an equilibrium. And even in gold-backed, when the dollar was gold-backed, it wasn't actually a fixed dollar for dollar. It wasn't even 30 cents for a dollar. It fluctuated between 20 and 40 cents of gold per paper dollar out there. But I think what we will see is a continued deglobalization, disconnection of markets, a reversion. China is leading a new global swaps platform that does allow anybody to exchange physical goods for currencies and settle surpluses in gold. And China now will allow you to settle your paper yuan into physical bullion in the Shanghai International Shanghai Exchange. So they're recreating a platform for creating a sort of a demi-gold or semi-gold backed currency, really just pegged to physical trade. That's my very long roundabout answer.
Yeah, and if we went back to a gold-backed currency, the price of gold, we just won't even go there. The numbers are eye-watering. Gentleman here in the second row. Can I have a microphone just here? Second row, just this gentleman here. That's it.
Hey, thank you. I think I want to refer to a couple of people. So Abdul before, the 13-year-old who was doing an assignment on like currency and money and that type of stuff. So being young and younger people being, I guess, exposed to currency, I don't think is very common, like in primary school and secondary school.
I know it's not.
I want to know what everyone's perspectives are if the government were to make an incentive towards adding that into the curriculum. And do you think, you know what I mean? Because now Australia's moving towards a digital currency and a lot of countries are. Do you think that gold will still be relevant in 100 years' time? And how can we educate further generations, not just this upcoming generation, on the importance of physical assets such as precious metals?
I'm going to give you a very short answer and then I'm going to throw to the panel. My short answer is that gold is money, has been around for centuries, will always be around. But I do think that schools need to understand and educate a little bit more. Having said that, when we held this event last year, we had a number of students come to the conference during the day. They came in with an attitude of, what am I doing here? They felt that it was all about mining and they were very against it. By the time they left, they said, we want to tell all of our friends, this was amazing, we've learnt so much. So we have to continue to educate and to encourage people that have absolutely no idea about this particular sector to get involved. So to your point, well, this year I think we've got approximately 40 students. Last year there was, I think, 12. This year 40. Hopefully next year 150, I don't know. But you've got to start the conversation and you've got to start the education and you've got to encourage. And I'm loving seeing that sort of younger generation come in. This is why we've, thanks to Michael, the sponsorship of this event enables us to make it open to everybody and have as many people here as possible. So all I would say is encourage everyone that's here tonight, that when we're back in a year's time, when who knows what will be happening, that you bring someone with you. It's the only way that we're going to start to help educate people that, in my opinion, it's just my opinion, money, gold is money and everything else is credit, and we're being destroyed by credit. But I'm going to throw to my wonderful panelists. Who wants to take that one on first?
Could I just point out that, and further to the other question, gold is a scarce resource.
Yes.
Its scarcity is what also drives its value. There's only so much gold in the world. I think it's debatable to fill so many Olympic-sized swimming pools, but it's not that much out there. So even if people lose track of gold and young people don't want to buy it, there's still not that much out there, and governments are still holding it, ETFs. There will be still some form of investment into gold, and because it's scarce, it won't particularly lose lots of value. And so people will always have some interest in it. And at the same time, I doubt people are losing interest in gold jewellery.
Can we also look at the time horizon you've just quoted? Or like how many countries that exist today as prosperous nations existed as prosperous nations 200 years ago? Right, there are a couple, but you're talking about, I think the durability and the duration value of gold is a really important thing. Every single currency ever invented has failed.
Everyone.
Right, every single currency has failed. Every empire has fallen, some multiple times. And so, we really can't forecast or predict what's going to happen in 100 and 200 years' time, but I can tell you many of the countries that are pushing digital currencies, or whether it's a paper currency or a digital approximation thereof, and look, we all have a bank account and we can transfer money, so we already all have digital currencies anyways, right?
Yep.
But the vast majority of digital currencies will be in the same bin as the old Mexican peso in 60 years, right? They're going to be defunct bits of code, just like those countries and the geopolitical structures that hold them together. So it is a very, very good question, and we simply can't answer that any more than just to look at history for the past 200 years.
All right, I do want to get through all of the questions, and I know that there was a lot of hands up. Keith. Right, Keith, good. Not 3 questions in 3 parts.
I'm just going to make a comment. So the reason why the gold shares may not be performing is because they don't actually, or the market doesn't believe the gold price.
The market what?
The market doesn't believe the gold price.
True.
So we had a similar situation in 1979 to 1980 when the gold price got up to about $400 the gold shares flatlined. So the gold price continued all the way up to 850 and came all the way down, and the gold shares did nothing. They just flatlined and totally ignored it. However, when it came back down to 400 and started to increase again towards 600, the gold shares tripled.
It's a very, very good, and by the way, everybody, Keith Good, he'll be around. He has Eagle Advisory Services. He has been in the industry for a long time. He's seen the ups, he's seen the downs, and that was a very good comment from him. Any other questions from the audience before? Yes, lady just here. Just wait for the microphone, just coming to you. See, I like this. I like us being interactive because we all learn the more questions that get asked. Yes.
Thank you. Good evening, everyone. Just a very straightforward question. What is the possibility of listing a platinum mine or a gold mine on an Australian trading platform to raise funds?
Well, that's almost a you one, isn't it, Jess?
Do you have a platinum mine you're trying to list, or is it completely
It sounds like
I
it.
certainly wish I did.
Well, I mean, there are, I'm going to get these numbers wrong. I think there's been about, I'm going to say 20 new IPOs, so new listings, of companies that have hopes and dreams, in most cases, of finding a mine. Now, that's in 2024, this year. We've had peak years for IPOs. 2021, I think, was about 117 IPOs. 2007 was about 125. So they're big years, and it sinks down to years which, like we're in at the moment. So very, very few of those contained actual mines. Some of them gone on to find them. So if I understand your question correctly, I would say that the prospects of listing a new platinum or gold mine would come very much down to the quality of what the earnings potential of that mine was likely to be for the market to decide to buy it and get it over the listing threshold. But in most cases, those companies come to market as explorers in Australia and Canada, which is the other big mining exchange in the world.
And so, madam, when you're looking to IPO or list a company, there's a process you go through. Typically, people will look to list maybe 2 years down the track. You'll build, you do some exploration, you'll do what's called pre-IPO fundraising, so you'll get some backers, whether it's some high net worth or some funds that will back you, and you'll go out and do a whole bunch of exploration drilling to prove up a resource, and then you'll look to getting some advice and working with a broker, an equity broker typically, that will advise you all the processes of, for example, going to an Australian stock exchange, ASX listing, and that's a significant process in itself. The ASX, there's a lot of hurdles to jump through and have you. So typically if you're planning on, you've got an exploration field, you're pegged and what have you, you prove up a resource, you've got some early stage backers that are there to help you, and you might raise, $1 to $2 million. And you look to go with a reasonable asset with good prospects, and you then use an equity broker to support you in doing all that process.
Can I also add to that? Oh, sorry.
Yep, go ahead, Jess.
Going back to the point about scarcity, we all know about the case study. It's not a case study, it's real life. So Rio Tinto had one of their mining licenses essentially revoked. So just because you've got your goods and your chattels, you've got your team, it doesn't necessarily mean you're going to start digging out of the ground and then shaping it up and then shipping it off and start earning money. ESG comes in, and then that's why the whole scarcity keeps prices appreciating while there's demand and supply dynamics at play. So that's another consideration as well.
There are more hurdles and more red tape to getting a mine even started than any of us have had hot breakfast in this room, all of us put together. It's an incredibly complex process to go through, and a lot of due diligence. It's governments and what they consider is the right thing, the wrong thing, and as Jess just said, ESG. There's a lot of things you have to go through.
Kerry, a lot of that comes down to what jurisdiction you're in.
100%,
Within
Nick.
Australia, whether in New South Wales or you're in Western Australia.
Well, we've got the...
Yeah, no, it's a big difference. There's a huge difference between New South Wales and Western Australia or Queensland.
Yep, 100%.
There's obviously a huge difference when you go to Latin America or West Africa, and that all changes very quickly too.
Right, I'm going to take 2 more questions from the floor. Wow. Okay, I'll take 3. Let's go to this gentleman. This gentleman just here. Oh, Paul.
It's been a terrific evening. My question is, how can a junior miner raise capital without going to their banks and being forced into hedging or having a share placement that tend to be more negative for the share price? In other words, what's the best way for them to raise capital, I guess?
Good question.
Just quickly on the debt side, and I think Headley's the best guy on the equity side, and sadly, in the current junior mining environment, you're always going to have to raise money at a discount to the current price, but Headley can talk about that. On the debt side, there's a whole, yes, if you're doing a big debt financing with your typical Australian or European or Canadian banks, their credit committee will often require an element of hedging as a part of their risk process. But it's also, I can assure you, very much a part of their money-making process. They make a lot of money out of the hedging, and they have a captive client when they're providing the 100 or 200 or $300 million of debt. There's a whole bunch of other financiers and debt financiers like ourselves, and there's a lot of them now globally, that's called alternative sort of debt providers that don't require hedging. We're more than happy to share security over assets with a hedge provider, so one of the banks, if the borrower, our client, would like to do hedging. Because there's a lot to be said for hedging at the moment. If you're hedging in Aussie dollars, you can get a great price if you do, typically, let's say you did 40% year 1, 30% year 2 of forecast production and 20% in year 3. That's probably a really sensible risk management policy. We don't require hedging, as we said, but we're more than happy if the client wants to mitigate risks, and we've all talked about cycles here tonight. Who knows where we're going to be in a year's time, but it's a great price. If you can lock away, let's say 3,750 Aussie dollar for an ounce of gold produced, you're going to make some good margins, assuming you can manage your costs.
Thanks, Nick. We do have to get... I just want to... Okay, very quickly, because I've got a couple more.
Well, the reason that's such a good question is it's a very obvious question. What's the best way to do it? And I think the answer is that just about nobody knows, because most companies that are raising money seem to, fall into a pothole one way or another. So there is a bit of a holy grail of how do I raise money at one price and then the next time it's higher and the next time it's higher. Effective promotion, a lot of luck, getting deliverable progress all in the right direction is, I would say, all contributors to that. But you know what, it's a cyclical industry, and sometimes that just takes away the whole runway as well. So you find that you've achieved a lot, and the runway of price is taken out from under you as well. So I think it's an excellent question, and I apologise that I can't answer it any more thoroughly than just generalising to say that it's often done really badly.
All right, we're going to take this last question here from a lady in the... Okay.
Hi, so we've talked about gold, silver and gold miners in the past 2 hours. So I'm wondering what's the panel's general outlook on silver miners in the coming years?
General outlook on silver miners in the coming years. I'd say that's a you one, isn't it, Headley?
Oh, look, Kerry, I'm bullish on silver. I mean, Abdullah, I think, was asked the question on silver. I mean,
yes,
we've talked a lot about just about every tonne of gold that's ever been produced still sits above the world. It hasn't been consumed. Silver, we've talked about the industrial production. Basically, we're in a decarbonisation world. We're in the electrification of everything. Silver goes into a lot of that, but most importantly, I'm sure many of you know about the solar panels and the consumption of silver in that and what's happening in the transition in energy generation. So, look, it comes back to good management, all the usual things. It comes back to a great project, which is typically is it open pit or underground. I mean, Mexico is obviously a big producer of underground silver. It comes back to grade. Grade is king. We all know that. But it comes down, I suppose, what I'm saying is to the margin you can produce. I wouldn't be surprised personally to see silver run to US 35, 40, even push that 50 barrier that we saw, I think, a little over a decade ago.
Yeah,
so
2011.
I'm a bit of a bull, probably over a 5-year period.
And many gold mining companies have silver operations.
Absolutely.
It's worth noting.
And lead and zinc.
And there's a company here, we don't have too many silver ones here, but Morona Metals have got a pretty good silver project in New South Wales, so you can go and talk to Richard Carlton and his team. Hedley, did you want to say one quick comment on that?
Yeah, well, a general outlook for silver companies. If you said, well, index for precious metals companies might have 20-odd companies in, you'd be lucky to find one silver company within that. Silver, they tend to be far fewer as a pure play silver producer. So the outlook for them is completely related to the silver price, and I think they're probably attached to economic trends for the silver price as much as whatever the outlook is for gold. But the other basket full of silver producers are the ones where it's a byproduct. So you produce copper, lead, zinc, gold, and then sell some silver as well. And I think the outlook for them is, well, it's often quite a bit better because two revenue streams, particularly if one offsets the other partially, isn't a bad thing to have. So I know that's a generalised answer, but...
I know we're finished.
Yeah, I'm like, we're out of time, Nick, but he's going, I don't care.
I want to ask the audience one question, because I really want to get a feel for the mood on gold.
You can't answer one at a time, all right?
2,500. Show of hands, who thinks the gold price is going higher than 2,500 in the near term?
We all better start buying today then.
No, it's just really interesting, the mood. And I mean, I hate to say it, Kerry, and I don't want to...
Well, we're the Church of the Converted. They're here.
Yeah, no, but I don't want to say it on a negative note. But what happened over the weekend in the Middle East is really scary. And we haven't talked a lot about the geopolitical issues. And we're not going to finish on that note, but it's very bloody scary.
I would tend to agree with you. Yeah, we won't finish on a negative note, but just be aware. The world is changing. The world is changing rapidly. You need to understand precious metals as part of your portfolio. But again, we don't know your individual circumstances, but make sure that you get educated. And that's what I love about Bullion Now sponsoring this evening's event. So can you please give it up for Michael and Bullion Now?
Very well taken.
And Nick, you're not leaving yet. You're not leaving yet.
I think Nick's got to do
doing the victory handshake.
Could you please give it up for all of our speakers, Alex Scanlon, Jessica Amir, Hedley, Nick and Jamie. All right. Ladies and gentlemen, really appreciate having each and every one of you here. Next up, we are going to Eureka 2024 party. EMR Capital, Barton Gold and Bullion Now are going to give you, what do we call it, libation and education. There are 40 booths out there. Please go and talk to them all. Our speakers will be here. Thank you so much. And by the way, before we go, I forgot, don't go anywhere. Don't go anywhere. I forgot one thing. Shane Anderson, get yourself up here. Quick. Shane Anderson is a really good friend of mine, and he owns a multi-million-dollar company. I'm not going to go into the detail of that, but Shane is a good friend of mine. He loves what I'm doing, and he just wanted to say a couple of words. So, Shane,
Everybody give it up for Kerry Stevenson. How amazing was that? And all
I paid
the
him to say that.
I think, for me personally, I mean, growing up in Australia, Gold Coast, panel beater, I had the life, right? I had a house and a falcon. I thought everything was good in the world. And then we started to invest in things like precious metals and gold. And I think the real critical piece here is about education. Who here agrees that they learned something in the last 2 hours?
Great.
Over the next 2 days, you are going to have so many, pardon the pun, nuggets dropped on you. I just came up with that. That's a gold nugget joke. And you're going to have the opportunity to learn more and more and more about the industry. You're going to be able to educate yourself. Ignorance is not bliss anymore. Ignorance is just plain ignorance.
Yep.
Okay, so you need to get out there and get amongst it and take the next 2 days. I think it's $200 a ticket. So if anyone is here and does not have a ticket for the next 2 days, please do yourself a favour. Do not think about investing in precious metals if you're not willing to invest in yourself. $200 is about the price of a lunch here in Sydney. Genuinely. And the $200 ticket includes afternoon tea, morning tea, and lunch. So that's covered. So guys, please don't hesitate. We are going to have, hopefully, a QR code pop up on the screen. If you do not have a ticket yet, just scan that, buy a ticket. You'll have it done in 2 minutes flat, and then you'll be here for the next 2 days. Even if you can't make the entire 2 days, if you made it here for 1 hour in the next 2 days, it would be worth the $200. So please, do yourself a favour, invest in yourself before you do anything else. Once again, please give it up for the panellists and the beautiful Miss Kerry Stevenson.
Thank you, Shane. If you don't know how to scan a QR code, go and see the ladies at registration. They'll be able to help you. But I do agree with Shane. This is just the start of your journey. This is just the start, I think, I don't know, but I think of a gold bull market. We do this once a year. So I think if you are not coming for the next 2 days, you definitely should. I know many of you in the room are coming. If you're coming, we have a dinner tomorrow night. I'm sorry, that's now sold out. But these people up here will be speaking over the next 2 days. They are going to be digging a lot deeper, excuse the pun again, and giving you more gold nuggets. No, they're going to be digging deeper. They're going to be giving you a lot more information. So if you're not here for the next 2 days, go out and get yourself a ticket. In the meantime, Mike Dotch is in the house, thanks to our sponsors, and he's going to be spinning the tunes and giving you some drinks and some canapes. Thank you so much for joining us, and I look forward to seeing you over the next couple of days.
The session tomorrow starts at 8 a.m. The exhibitors will be in the house, and the session formally starts at 8:30 a.m. Hoping to see a lot of people here tomorrow. Enjoy yourselves tonight.